Okay, so I think we move on to the third presentation. Martin Hellwig is the director of the Max Planck Institute for Research on Collective Goods and professor of economics at University of Bonn. His research has addressed issues in many fields of economics, including the economics of information and incentives, financial markets and financial institutions, and financial stability. In addition to multiple articles in leading journals, he is the author of a book that has been raising a lot of discussion in Europe and I think also in the US, The Banker's New Cloth, What's Wrong with Banking and What to Do About It. Hellwig is a member of the Scientific Advisory Committee of the German Ministry of Economic Affairs. He also was the first chair of the Advisory Scientific Committee to the European Systemic Risk Board and previously chair of the German Monopolies Commission and of other relevant committees. So I think he has the view from both sides of the table on these issues of banking risk, and that is something where he will also speak about. Hellwig has teaching appointments at Princeton, University of Bonn, Basel, Hebrew University, Harvard University, and University of Mannheim. I'll leave it at that and hand over to you, Martin.
Okay, I hope I can do this. My voice has been disappearing during the day. I suppose I'm the only person today who's not actually in finance, but in economics. And I suppose that's a token to the effect that Steve has had on economics as well as finance. Now, my connection to Steve is actually an indirect one. I did write a paper once on information aggregation in markets, and Steve actually read that paper. This was the time when people still read papers as they were being published, rather than waiting for people to come around on the seminar circuit. And he thought this is a great thing to torture graduate students with. And one of the graduate students actually continued to work on them, and this is how I got to know Anna Atmati. So I'm basically standing in for her. One of the words in the title for this panel is efficient markets. I always get uneasy about that. Of course, markets are wonderful. The market economy is wonderful. Efficiency is wonderful. So efficient markets must be really great. The problem is, this is not what we're really talking about when we talk about efficient markets in the sense of the efficient markets hypothesis. First thing, we need to distinguish between information efficiency and allocative efficiency. And that's a distinction that's all too often neglected. On information efficiency, the greatest paper I know is one by Richard Roll, who is sitting here, Orange Juice and the Weather. This is about the relation between the prices on futures contracts on frozen orange juice concentrate and weather forecasts in Orlando, Florida. AER, December '84. The paper has two messages. The first message, the market is informationally efficient. To put it more concretely, the US Weather Service could improve the quality of its weather forecasts if it conditioned its forecasts on market prices. And that's, of course, very much in line with the notion that markets are institutions that aggregate information and communicate information through prices. The second message, markets are very noisy. If I remember the numbers correctly, only about 1/5 of the variance is explained by things that we can identify, including weather forecasts, and 4/5 are noise. Now, when the Nobel Prize was awarded to Bob Schiller and Gene Fama simultaneously, many journalists said, how crazy. Their sayings contradict each other. My response usually was, well, these scholars have two different messages. Gene's message corresponds to the first message of Richard Roll's paper, and Bob Schiller's corresponds to the second message, namely there is a lot of noise. And both of them have moved forward our empirical understanding of what's going on in these processes. So I'm actually a firm believer in information efficiency. Not strong information efficiency, but very definitely weak and semi-strong. I also believe very firmly that information efficiency has very little to do with allocative efficiency. And there are a number of reasons for that. First of all, the more information gets out, the less you're able to insure against the risks attached to that information. This is something that Hirschleifer discussed in the early 70s. Secondly, what about allocative decisions taken on the basis of the information? And thirdly, what about information acquisition? Information is usually costly. What about allocative effects? There is one allocative effect which I think is important, for which information efficiency is a very good thing, and that's market liquidity. If you think about stock markets, if you have markets where you don't really know what's happening, you always have to be worried that the other side will take advantage of you. And this is, for instance, why in markets with very infrequent trading, spreads are very large. What about other allocative effects? We need markets to be informationally efficient in order to guide investment. One problem I have with that message is that stock markets of established companies don't finance that much investment. IPOs, yes. But if you look at investment funding of established companies, not that much. Markets serve to reallocate control, takeovers. That may actually have to do with informational inefficiency, but let me leave that topic aside for a while. Markets provide incentives. Shareholder value is needed in order to give management proper incentives. Market discipline. Well, that's again a weasel word, which we love to use without explaining what we mean by it. In goods markets, we know what we mean. If a company sells me a bad good, I won't buy it again. So survival is necessary. For survival, it's necessary to provide goods. In capital markets, once I've given someone my money, the money is gone. If I'm defrauded, I won't do it again. But the person who's done the defrauding couldn't care less. Mr. Vesco, who took those 300 million in his suitcase to go to, was it Bermuda, Costa Rica, never mind. He couldn't have cared less about the fact that he couldn't get any more investors for his funds. So if you don't have to go back to the market discipline is very dubious. Now, we've seen this very strange phenomenon that Whereas shareholder value was a dirty word in corporate boardrooms as of 1985, by 1995 in the US and by 2005 in continental Europe, it had become the norm. And this along with the change in compensation systems. Market discipline at work. The problem with that is that most of those compensation systems have very little to do with incentive theory. For example, if the central bank lowers interest rates and asset prices go up, you've just given evidence of that, shareholder value goes up, corporate managers are rewarded for something that's been done by the central bank. Has nothing to do with incentive theory. In my view, and of course, if they take market risk, again, same thing. One of the interesting features is how come this discourse changed so dramatically? I mean, discourse, the rules of discourse in corporate boardrooms changed so dramatically between 85 and 2000. In some sense, I mean, my view on that is the trade-off between tenure, i.e. power, and money changed. There were enormous gains to be made from reorganizing corporate sectors, and corporate management participated in those. Interestingly, at the same time as we saw this switch, we saw a reinforcement of corporate defenses against hostile takeovers. The early 90s are a period where poison pill jurisdiction gets entrenched. Now, what can we say about welfare effects of market discipline? Of course, to the extent that we think of market discipline as just being a pretext for managerial enrichment, the question is not even worth addressing. But suppose we take the welfare effects of market discipline in the various theoretical models that we have where something good is supposed to be coming out of it. Question one, what about noise? Here I'm back to Richard Roll's finding on noise in the market for orange juice, presumably also have noise in the way in which market prices respond to managerial actions. What about information acquisition? To what extent is information acquisition, the whole industry of analysts that we have around the market, driven by distributive concerns, and to what extent is it driven by enhancement of efficiency? Remember when Gary Becker wrote about the economics of crime, he said the real problem is that this is a redistributive activity and the thief is using productive labor for a purely redistributive activity. That's a welfare question which we must raise in the context of the institutions that make for market efficiency just as in others. What about distribution between different claimants? And what about information collection and information acquisition and information processing when we have more than one market, more than one security issued by a firm? Most models of market discipline through information and incentive provision through information in prices focus on one particular security. So typical example is moving to shareholder value may come at the expense of the ability of a company to commit to long-term relations, and that may be good for shareholders, but it may be bad for others. Debt funding of takeovers may be a way to dilute the position of incumbent debt holders. On the incentive side, incentives for acquisition, for information acquisition, I note that we actually have two competing sets of theories as to what we mean by market discipline. We have a theory about incentives from shareholder value remuneration, and a theory about incentives from a fear of a bank run. If you look at Kalomiris Khan, Diamond Pajan, the story is these institutions must be funded. All outside funding must come from short-term debt, and that debt must be runnable. So these guys are always observing what the managers do, and the managers are on their best behavior because they're afraid that if they step just one little bit out of line, there'll be a run. Two different sets of securities, two different models of market discipline. How do they go side by side? I note in this context that equity is more information sensitive than debt, something that Gary Gortner and co-authors taught us, which suggests to me that shareholders might have a bigger incentive to invest in information acquisition than debt holders, which suggests to me that maybe the debt holders would just free ride on the stock price because the information of shareholders might be contained in the stock price, which means that as long as stock prices are going up, they don't care. Just like many of those repo lenders didn't care as long as the stock price of Lehman Brothers was going up. And when it goes down, well, maybe too late. But that's when they care and when you get the run. The more general point is we don't know about how these things work when we have different claimants and different incentives for information acquisition, and distributive effects between them matter. Let me make a more general comment on the development of contract theory and financial economics. And this goes back to the term efficiency. I think we have an efficiency bias in economic theory. The original Jensen-Meckling paper said, let's explain capital structure, let's explain observations, institutions, as solutions to information and incentive problems that the participants face, which has been an extremely successful research program altogether, except there is a bias. If we explain what we see as being efficient, then we conclude that everything we see is efficient. And I mean allocatively efficient. There are two drawbacks. One, second best efficiency is not first best efficiency. If you think about a simple moral hazard problem, there may be a case for government subsidies to fire extinguishers, because that reduces the agency cost involved with insurance. Secondly, and that's a deeper point, all these models that we have and all these analytical approaches that we have assume commitment. Or they assume that the commitment structure, the game form, is given. I've rarely seen the question raised, could there be a point for government intervention? So this is not about limits, but about potential for policy, for government intervention to strengthen the scope for commitment. Two examples. I've done research a long time ago on much of banking theory assumes that banks diversify. What if we don't assume that, but allow them to choose the degree of diversification? And the answer was there are strong incentives not to diversify. Second example, joint work with at Mate de Marzo and Fleiderer. Once you're indebted, you have strong incentives to go further into debt in order to get the better of incumbent debt holders. So purely private incentives, not social incentives, rather than reduce leverage, even if new information comes along that suggests that socially it might be better to reduce leverage. The problem in both cases is a lack of commitment. Intervention that changes the nature of commitment structures might actually improve the allocation of resources. And I think that in our theoretical approaches to institutions, contracts, and the phenomena that we see, we need to complement the Jensen-Meckling approach of how to explain the things that we see by questions of the sort, are there ways to improve relative to the second best that we start out with?
So we have only a few more minutes, and before delving further in this question, I would like to ask one question to each panelist. And in light of what you have been telling us about the impact, the relationship between, let's say, monetary policy and asset prices, the doability of real effects via lending channel, or the market discipline effect, what would be a policy advice that you could distract from your work and your analysis that one can communicate to the outer world? So you have done your research, you have done your analysis, now comes up a policymaker and says, very interesting what you say. Maybe we start in reverse order, so since Martin is still at the microphone, and you make this analysis of market. So what can we do to make, let's say, this element of our financial system better work? Is there a way?
You know what the answer is going to be. We've written a whole book about it. Force banks to reduce leverage. And by the way, this is a point where most bankers exhibit short-sightedness, because most bankers think about equity as being expensive from their own private perspective. And they don't see that if a regulation applies to all institutions in the industry, it may enable them to earn higher margins.
Mm-hmm. So, do you want to go first, Jean or Joseph? Can you give him?
I think the reason that they fight against more equity is because it kills the value of the put that they have on us. That there is a real value to that put. So the more levered they are, the higher the value of that put. But I agree with you entirely. We don't want to give them the put to begin with. But I had another. I don't remember, Dick, in your paper. Did you do a variance ratio test?
Yeah.
Did you? And how did that come out?
You're asking something 25 years ago.
Well, right. But what I'm suspicious of calling everything that you can't explain with an explicit variable noise, because I think there's a simple statistical test that puts an upper bound on how much of it is noise. If you just do a variance ratio test where you add up the returns and calculate the variances, the degree that you can actually, the upper bound on what you can attribute to noise is the difference of that ratio from n. If it goes up like n, then you can't say it's noise. And it's the difference between that you can basically attribute to noise. Now, I know it's close to n, right? Right?
So and then on this greater question, is the Fed strategy in vain? So they shouldn't try?
What's the policy? No, right. I agree with Martin entirely. Getting rid of the put is really important. I mean, that's such a perversion of capitalism, it's ridiculous, that put option. What policy implications would I draw from this? Less policy is better.
Less policy is better.
Right.
Joseph, you have the last word.
Well, if the question is how can regulators use prices better, when it comes to microprudential regulation, I'm skeptical whether this works, because there's too much scope for manipulation. I think there have been attempts of forcing banks to list junior debt but I don't think these efforts went very far. When it comes to sort of macroprudential regulation, I think the toolkit of regulators is very archaic, in a sense that, as far as I see, they rely not very much on prices. And here, I think we have a sort of a loop back to Steve's talk. I'm very much a fan of options, and why not rely on information of out of the money put options? There's disaster risk indices, and I think these directions have not been exploited enough.
Is there anything else you want to say? I mean, I could imagine that if Steve's technology would work and you can extract expectations, even the distribution, you could learn much more as policymaker about what you are achieving or not achieving, right? Because expectations will respond to your action.
I just assume they stay there timid and not want to do too much policy, actually. Go ahead.
Mark, I'd like to defend security analysis. Imagine there's a lot of noise, which we all agree with. Don't you think there'd be a lot more if people weren't doing any security analysis? Even though they're doing it in their own self-interest, they're trying to redistribute income themselves. I agree with that entirely. But in the process of doing that, they must be performing some social benefit in terms of noise reduction, don't you think?
I did say that the information that's being processed does provide for the liquidity of these markets, and that's good for allowing people to use these markets and to use these securities as stuff that they can rely on to get funds if they need them. That's a positive allocative effect. The really surprising thing for me about this, sort of as a consumer of the empirical literature, has always been just how little we can explain in terms of the day-to-day movements of these prices, and how our notions that we start out with as when we first learn this stuff, that these prices are very much driven by information about fundamentals and things like that, how that is not to be seen directly in the data.
Steve, you have the last word for this.
I don't know if I should have the last word here, but I found this to be fascinating. There's more things here with which I disagree than I can catalog, and more things with which I agree than I can catalog. It's just an endless profusion. There's some wonderful things here. I wish every graduate student could sit in and look at all the different research topics that were going on here. Let me seize upon two. First, Gene, you could do all the variance bound tests you want on the orange juice paper, and you'd still come up with the same result. I didn't think it was 20%. I think you were getting R-squares of like 0.5%. And you're running on the only things you think that matter, the weather. So it just seems there's just too much noise. No, it's my turn. It's just too much noise in that thing. The put is very interesting. I've always puzzled about that. So it's not that the put directly does anything to reward the management of the bank. They still get fired if the bank goes under. What the put does is it removes the bank from market discipline. You know, and that's the thing that's really the frightening part about the put. The additional thing of it is that we all pay for it. And furthermore, we don't get to vote to pay for it. It's just really quite a tragic combination of things with the put. On Gene's thing, I just had a question for you about that. I wonder if you're sort of getting trapped in the very structure you don't like so much, old macro, because you spend so much time talking about they can affect the short run. On the long run, they have no ability to affect the long run. That's long accepted, the short run. But there's another phenomenon going on. For the first time, the Fed decided to delve into the credit side of the spectrum. And they bought all these mortgages and things when they were selling for 50 cents on the dollar. So they bought $3 trillion worth of this stuff. That clearly had an effect upon.
Because they ended up holding a large fraction of the supply.
Yes, right. And that got me to the second point I was making. This, the 17% you found, maybe the 17%, it struck me as a number that seems similar to the effect they could have as just an ordinary supplier and demander of capital in the market. Forgetting their role as the central bank, if they just decided to buy stuff, they could probably buy 17% of the stuff anyway.
Sure.
Yeah, so that's probably the 17%. It just seems similar to me to that.
Does it mean it's a small number or a large number then, the 17?
No, it just means that the channels Gene described are exactly right.
Yeah.
Because there's, because in effect reserves no longer have an opportunity cost.
Wait, you have to be careful because the last change in the target rate is 2008.
Yeah,
So all of that testing is being done on data where what they're doing in the market is so trivial in size, it's
Yeah.
not 17% of anything.
it
It's
doesn't
$50
matter. It's
billion
the
worth of
potential they
reserves
have.
that they're nibbling on the edges of.
No, I think the interesting issue is that reserves are no longer anything, except there is a higher profit margin because it's a non-competitive market for the acquisition of reserves. So it is, even though it's a small percentage of the total assets, they earn more on it, and they don't compete it away, all right? So it's a little tricky there.
It
But
is
I
tricky.
I like the 17% because it's really, you know, I sort of think to myself, suppose the Fed was completely privatized and they just decided to buy and sell stuff like
Right.
anyone else. It's sort of like if BlackRock decided it was going to really buy a lot of securities,
It's
maybe
different.
they'd be
It's
10%
different.
or something.
No, it's different. What makes the Fed different is that reserves and currency are exchangeable on demand. So the price of a dollar of reserves can't go above a dollar.
Yes.
Okay, if Goldman Sachs does the same thing, the price of what they issue can go above a dollar. Because they don't stand ready to exchange
It's
currency.
just
for
like
reserves.
breaking the buck for a money market fund. But let's take this offline.
Yeah, right.
No, I think we all enjoy online, and I want to thank you for your contributions. I want to thank the panel for their contributions, and thank everybody for being here. But in particular, of course, Steve, for your presence today. And so.